When the markets are doing really well, it can be really challenging not to suffer from FOMO, fear of missing out, and to stop yourself from wanting to pile all of your money, every single last penny, into a stock that is going up. And likewise, when the markets are crashing and everything in your portfolio is plummeting, it's really, really difficult to stay convicted and to stay invested and then to keep investing. I've actually seen both of these scenarios now. Now, I've not been investing for decades and decades, but the time that I started was quite unique in that it was just before the markets crashed in 2020. We all knew how that went. So, of course, as a newbie investor, didn't really know what was going on. I saw my portfolio plummet. Mind you, didn't have that much money in there at the time, but it was still really disheartening. And I was kind of sat there thinking, hang on a second, have I invested into the wrong things? Or is this truly the one time in history where the markets really do collapse? So because of that fear and because of the lack of wider perspective that I didn't actually have at that time, I decided that I would stop my direct debit investment setup and just wait and see what happens to the market. What I didn't do is withdraw my money, so I'm happy about that. I left it alone, but what I didn't do, which I regret, is I didn't keep investing during the times when it was dipping. Now, in hindsight, which is a great thing, what I should have done is carried on investing, but not just carried on investing, I should have doubled down. I didn't, and that is a lesson that I've learned. And now, of course, we're in a little bit of a cycle where all of the tech stocks are going a little bit crazy. Now, in my own portfolio, I have Amazon, I have Alphabet, I have Palantir, I have Tesla. All of those four, especially the latter two, because of the size of the amount of money I've got in those positions, are looking very nice right now. And I know a lot of people are having FOMO. And a lot of people are wanting to put loads of money into them positions in the hope that they can ride the wave up and get lots of profit. And then other people are saying that they really regret not buying in when the prices were lower. So they're having a little bit of FOMO. Now, through the experience that I've had so far in the market and just from studying other people that have been successful and reading about different types of investing strategies and all of this, I've kind of come to my own strategy that is currently working for me, and I'm going to continue doing this. So I just wanted to share it with you because you hear a lot of this idea of lump sum investing versus dollar cost averaging. So lump sum investing, just for you, for those of you who don't know, is basically where you put in a lump sum of money at one given time and then you just leave it to grow. You don't really worry about it, and then maybe you'll come along again and put another lump of money in and move on with your life. Dollar cost averaging is also very passive and very easy. What you do is you basically invest a particular amount of money at particular time points. So you might decide that you can afford to invest £50, so you do that at the start of every month. And that £50 maybe gets split up between the positions in your portfolio, or it just goes into an ETF if that's all you've got, whatever. But the idea is that you're not looking to see if your stock's up or down. You're just simply saying, okay, I have £50, it's going to go in on the 1st of every single month and it's going to buy me shares of X company, no matter what the price. And obviously the whole idea of that is that sometimes naturally it's going to land where the 1st of the month or the 15th of the month, whatever it is you've picked, is quite a cheap time. You know, the stock's declined a little bit and you're buying it at a little bit of a dip. Maybe not the dip, but you're buying it on its way down perhaps. And then other times, again, naturally, the stock is going to have risen. And you're going to be paying slightly higher prices, which means for your £50, you're not getting as many shares as you did the month before, perhaps. And over time, you sort of have this pattern where you're buying at regular intervals. And over time, the idea is that your average price averages out, dollar cost averaging. Now, a lot of people love dollar cost averaging. And I think it's a really great strategy just to do what you've got to do and not worry about it. But there are studies that show that lump sum investing actually gives you a better return. And the reason for this is not because, you're able to pick a better time to invest with lump sum investing. It's purely because, well, this is my conclusion anyway. If I'm wrong, let me know in the comments. It's probably because you are getting in earlier. So we've all heard the saying, time in the market, so time spent invested, is better than time in the market, trying to time them dips. And if you're lump sum investing, let's say £5,000 on the 1st of January 2015, really random date there, and you just leave that alone, and perhaps you come back the next year and you do the same thing, or you up the amount you can invest because you've got pay rise at work, whatever. So your money has been invested since whatever date I just said in 2015. Was it January the 1st? We'll go with that. Whereas if you dollar cost average across the months, across the years, whatever, you're putting little bits in here and there. And maybe you'll have £5,000 at the end of 2015. Forgetting the years that I've said. But the whole amount of money wouldn't have been invested at the start. Does that make sense? So you're not invested in the market for as long. Therefore, your money has not had as much time as it possibly can to compound. And that is the key. Compounding. That's how people truly get rich and reach financial freedom because of investing. One of two things happens. Either they get really, really lucky and the conviction that they have for a particular stock pays off, or a particular investment. And maybe they wait a couple of years and they 15x their return. I don't know, whatever. That happens. And then most of the people, they have stayed committed, they have stayed invested, and they have let time do its thing. And in X amount of years, they have been able to reach financial freedom because of the power of compounding. And it's that compounding that allows the average person to become a millionaire. Anyway, I'm going off topic. I wanted to speak about how I'm viewing the market and what sort of strategy I'm following at the moment with my own investing and my own buying into the market. So I've said time and time again that my strategy is basically to put regular money into my investments, into the positions that I have strong conviction for at regular intervals. Now, I am not saying I dollar cost average necessarily, because I never ever do. It's not at regular intervals enough for me to say that I do it on the 1st of every month, or I always put £100 in on the 15th. It's not that precise for me. But what I do is I always regularly invest, right? Sometimes that is twice a week. Sometimes that is once every 2 weeks. Sometimes the twice a week are smaller amounts. Sometimes the once every 2 weeks is a larger amount. Sometimes it's the other way around. There is no rhyme or reason necessarily to when I invest. What I do is any spare money that I have, any money that is ready to be put to work for me, and that comes down to my own budgeting, etc., will go into my investment portfolio. I'm trying to be aggressive as I can right now. So I do that. And then what I also do is if I see a particular time when one of my positions is going down, so let's say it's dropping today, and I feel like that is a great opportunity because that is a stock I would be buying anyway at whatever price, really. I say whatever price, you know what I mean. I will see that as an opportunity and I will buy at that price. So what I'm trying to say is I invest regularly, but if the prices go lower, I will double down and I will buy more. Now, this is not timing the market. And a lot of people think this is timing the market because I guess they imagine you sitting there watching for the very dip and then trying to time the market and get it at that price. It's not that, because one, I'm buying on the way up as well. I'm buying at regular intervals all the time. But two, I'm not trying to time that dip. I'm just seeing that, okay, my favorite stock right now, whatever, has fallen by 10% over the last 5 days. That looks like a great deal to me. I'm going to put some extra money in. Now, there's actually a strategy that kind of describes what I'm doing. I'm not really doing dollar cost averaging or this other strategy. I'm kind of doing a mix of them two and another aspect perhaps. But there's a strategy that you may not have heard of. So there's dollar cost averaging, and then there's this one called value averaging. And just to give you guys a definition, value averaging is an investment strategy that involves making regular contributions to a portfolio over time. But instead of investing at the same amount each month, like dollar cost averaging, the investor invests more when the price of the portfolio value falls and less when it rises. So this is talking about looking at your entire portfolio value and investing more when it falls and less when it rises. So you are basically taking advantage of market volatility and you're not just buying in at any price. Now, the reason that this aligns with me a little bit is because I am looking and buying more when the prices drop. However, that isn't from looking at the entire portfolio value. I'm more doing it on a stock by stock basis. So I'm seeing that my favorite stock or whatever has dropped by 10% over the last 5 days. And I just see that as an opportunity to put the same amount in maybe, but get in more shares or put in even more money in because it's on sale right now. But what I am doing is I'm still buying at normal prices and at higher prices as well. So I'm kind of doing that dollar cost averaging aspect where I'm not actually trying to only buy when it falls. If you are following value averaging, you are able, providing you do it correctly, to get a little bit more of a cost-effective strategy going. Because like I said, you are taking advantage of market volatility and you're not just investing the same amount each time, regardless of the price. However, it's more time consuming because you're having to monitor your portfolio all the time to actually see when the value falls to then adjust your investment accordingly. What I tend to do is I'm always trying to allocate regular money to invest in, but I always make sure to hold a little bit back. So if my budget is £500 this month to invest, I'll probably invest the majority of that. But what I will do is just try and have some sitting on the sidelines in cash so that if an opportunity presents itself that month or the next month, money can roll over, then I will put that money to work and I'll buy more. It's kind of like going to the supermarket each week. You go to the supermarket each week and you always buy the same tin of soup. It's your favorite soup and it costs you X amount of money. If you go 1 week and you see your favorite soup is discounted by 25% or 50% and you were gonna buy it anyway because it's your favorite soup. You buy it every single week. But 1 week you go and it is reduced by 25 or 50%. You should probably buy more at that price and store it, because that means next week you're perhaps not going to have to buy any soup, or hey, you can just have an extra tin of your favorite soup. That's a really silly analogy, but basically what I'm saying is it would be really stupid of me to see my favorite stock that I have strong conviction for down by 50% and me just think, well, I'm just going to buy it at my next opportunity, which is on the 1st of July, even though it's the 20th of June and prices may change by then. I might as well, if I've got the money, double down and buy more whilst it's at that price. And then maybe I won't buy as much when it goes up. These things can vary. The reason for this is you're buying more shares at a lower price and then the profit will be more when the market goes up. Now, I do quite like looking at my portfolio and my favorite stocks often throughout any given day. So I am kind of a bit more obsessive than maybe the average investor who doesn't want to do that. And that's fair enough. In that case, you don't have to do that for sure. You can just set a direct debit up and stick a regular amount of money in or lump sum invest. They all work. The important thing is that you're investing. But what I will say is I'm not necessarily sitting there watching the market every single second of the day and thinking, oh, this stock's dropped by 2 cents. Should I buy it now or should I try and see if it gets down to 3 cents? I'm not doing that. That would make me crazy, honestly. It's more like I just keep a general eye and maybe I see a particular stock drop in by a couple of percent each day and I slowly think, okay, this stock is getting to the point now where it's at a bit of a discount for me. I'm going to start adding more. I'm going to be adding £50 more to my regular investment into this position. And I'll continue until it goes back up. And then when it goes back up to normal prices, I'll just add my regular amount and I'll keep doing that as it continues to go up. And then, hey, if it drops even more and we get to down by 20%, 50%, which we have seen with some of these massive tech stocks on 2021 when they started dropping, then maybe I'll put an extra £100 in, an extra £70. It obviously depends on your budget. So I'm going to leave it there. A little bit of a rambly video. I just wanted to share some of my current thoughts about this topic. Sorry that it wasn't too structured. I just wanted to literally word vomit that out. Let me know what your strategy is, what's been working for you. And if you want to come and join the Patreon, get access to our Discord where we chat every day about all different stocks and investment strategies, I'll leave a link in the description below. Thank you for supporting this channel and I'll see you next time in another video.